Hi, I'm James Robinson, and this is my stock pick of the week. Generally speaking, my stock pick is just a stock that I happen to think is a great pick that week. I analyze all the fundamentals about the company, trying to look for companies that have either a durable competitive advantage, fantastic returns on investments, or another way meet Warren Buffett's precepts for what makes a great company. I analyze these companies in a vacuum without looking at the stock price. I simply look for fundamentally solid companies. Once I've done that, then and only then do I look at the stock price to see if I'm getting good price for the value of the stock that we're looking at. The stock pick of the week is H&R Block, symbol HRB. H&R Block is a tax preparation company founded in 1955. Since then, they have completed over 800 million tax returns. They have 12,000 offices. In 2018 alone, they completed 23 million tax returns. H&R Block has offices in the United States, Canada, Australia, and related territories of those countries. The company is based in Kansas City, Missouri. As of April 9th, 2019, the company had a market cap of $5.7 billion, revenues of $3.16 billion, profits of $705 million. Its PE ratio was 7.55, the yield is 4.09%, and the company has $1.88 billion in debt. Here you can see the heat map for the company. This is again the way I try and analyze the company in a global sense, looking at all of the components. Again, we look at 29 various metrics. 9 of them are operating, 10 of them are financial, and 10 of them are management. Operating is how well and efficiently they deliver goods and services to the companies, to their clients. Financial is how well they handle risk and how much debt they have. And management is what kind of job they do in terms of returning money to the shareholders. The only red mark, the only one on our score, everything's great on our score of 1 to 4, 4 being the highest, 1 being the worst. The only one they have is an interest expense. The only area they're not a top flight company is in financial. That's because they have taken on additional debt over the last few years. However, they've done such a great job of returning money to the shareholders and paying dividends that I'm not really that bothered by that. I'd love to see them pay off debt, but they're using the money to pay off me instead, and that's not the end of the world to me. This company is in the top 13% of the 850 companies that I looked at. It's also very, very cheap, with trading at a PE ratio of under 8, which is one of the main reasons why I'm advising that this is a company you should consider buying. As always, we start our search by looking at gross margins. The gross margins for this company, you can see, have been very, very stable, sort of bouncing around the desirable gross margin level. The last 3 or 4 years it's been above that level, which makes it more of a buy. But what I'm really pleased with is since 2005 the company's been very, very stable, and since 2006 it's always been above, it's always been in the realm of and approaching and being above my minimum, my desirable gross margin level. So this company does appear to have a lot of the traits of what we call a consumer monopoly based on this. So our earnings and earnings per share, if you ignore what happened in 2007 and 8 when the company lost money, again, that was in the middle of the financial crisis. The company's sort of done a pretty good job. In terms of straight earnings, they've managed to go up the last 2 years. They're up since 2013, one bad year in the middle there. If you look at, more importantly, earnings per diluted share, they're even more up, and that's because this company's done such a great job of buying back shares. But these are stable earnings, steady earnings. This is a business that's been around a long time, since 1955. They're doing tax returns. There's nothing evolutionary or revolutionary here. They just got to do a good job of blocking and tackling, and every year they make a profit. And because they're buying back shares, those profits per share are getting better and better year after year. Net earnings as a percentage of revenue. You can see again, this has been going up the last 2 years. It's gone up. It's above the top 25%. Really every year since 2009, with the exception of 1, and it's in the realm of, it's approaching my goal and in the realm of the top 10% in terms of the last couple of years. So it's nothing spectacular, but it's solid and it's very, very consistent. And again, sometimes if you can buy a stock really, really cheap and it's just very consistent, that something makes sense. And a company's trading at 7 times earnings with this kind of consistency, you have to wonder why the PE ratio is so low. So we always talk about what I call the 4 taxes. That's selling, general administrative, plants and equipment, research and development, and inventory. These are costs that businesses have in varying degrees, and you like to see a company do a good job of managing those costs. So selling and general administrative, if you know what this company does, they have 12,000 centers around the country from which they provide services to people who need to prepare their taxes. There's going to be a certain amount of selling and general administrative in an operation that's got that many different units going on. So they're really in the top half in selling and general administrative. It's disappointing, but I recognize because of the business they're in, this isn't disqualifying. Again, when you look at plant and equipment, it's actually kind of surprising that their numbers are so low. They're just outside of the top 25. But again, when you have 12,000 sites, and they're all pretty small sites, so there's not economies of scale, it's not the end of the world. And I knew with this business that was going to be something we were going to be facing. But the good news is that the next slide, which is inventory, they have none, and research and development, they have none. And so those two things sort of make up for the fact that they're in the top half, but not significantly in the top half in selling general administrative and in plants and equipment. So solid overall, even though a couple of categories are weaker than I'd like to see. Debt analysis. The first thing they'll do is look here in 2007. This company had $6 billion in debt. It had current liabilities, total liabilities of $5 billion. I mean, this was a company that was in real trouble. And virtually every single year since then, their total debt has decreased. Their total current liabilities have decreased, so they're getting more and more and more efficient at running their business. In 2015, they took on a little bit of debt, but again, that's not the end of the world, because if you look at the profits, what's going on, and they used a lot of money to buy back shareholders. They could have avoided taking on that debt and not bought back shares. But again, they haven't taken on any debt in 2 years, so I'm comfortable that this was not the end of the world, especially not relative to earnings and profits. Use income to pay off long-term debt. So this actually did cause me some concern. You can see that every year they've been below my goal, which is about 4 years to pay off debt, 3.5 years to pay off debt. The idea here is if they took all of their profits and they just plowed it into paying off debt, how long would it take to be debt-free? And I don't want to see that number get too high, because it means when the times get tough that it's hard to do this. But they did for 2 years, and recently they did get that number where the debt was too high relative to their profits. And it wasn't in the danger zone, but it wasn't below my goal zone. This is, the debt for this company is the reason that it's not in the top 5% of companies. And this is an example of why. Again, this and the fact that in the previous slide, I showed that it actually increased their debt over the last 3 or 4 years. So that's why this company isn't a 5-star company. It's probably a 4-star company, but it's just a really, really cheap 4-star company. So the interest expense, not a lot really to see here. It's kind of stable. I like to see interest expense below about 15% of operating income. They've always been below that number and relatively safely below it. So there's not a lot here to worry about. The problem is that I'd like to see interest expense going down, not going up. And with this company, the opposite is true. But it's, again, not the end of the world. So cash and marketable securities, if you knew nothing about this company, would be something where you'd be very concerned. They had about almost $2.5 billion in cash and market equivalents in 2013, and it's plummeted dramatically since then. Now they have, call it $150 million or $100 million or something in cash and marketable securities. This, I think, is just demonstrating that the ownership has taken a different approach. Rather than hoarding money and keeping it in the bank, what they've chosen to do is to recognize they have stable income streams, a stable business model. They sort of can predict what's going to happen in the business going forward. And so rather than keeping a bunch of money in the bank, they're using that money to pay back its shareholders, pay dividends, and to buy back stock. And so this doesn't worry me very much. I would prefer to see a little bit more money in the bank, and I would prefer to see, this level in 2018 level off and hopefully start to go up gradually. But because I understand what's going on, and we're going to see later in the management section what this company is doing, I'm okay with these numbers. One of the reasons that I'm okay with the cash and marketable securities is when you look at current assets to current liabilities, they've taken their current liabilities down dramatically. We already talked about that earlier. And yet they've always managed to have a nice buffer where their current assets do outstrip the current liabilities. And in fact, the buffer between the two is getting wider for the last couple of years. And so I'm not tremendously worried about the fact that they don't have much cash on hand, because they clearly don't need the cash on hand. The current assets and current liabilities are really in a pretty solid spot. So shares outstanding, this is a slide that really does warm your heart if you're a stockholder. This company had about 400 million shares outstanding in 1999. Today, they had about 375 million shares, 400 million shares outstanding in 1999. Today they have about 180 million shares outstanding. So they've done a spectacular job of just buying back shares, chunk, working it down, really enriching the shareholders. And again, the stock purchase, you can see that almost every year with the exception of 2008 and 9 and a little bit in 2015, they've managed to buy back some shares and thus create better wealth for our shareholders. So here's the way I like to look at the stock repurchases. If you own 10% of H&R Block stock at the end of 2008, you'd own about 32.5 million shares of stock. Today, through stock repurchases, your $32.5 million would mean your ownership in the company has increased from 10% to 15.23%. So without spending a penny, the management of your company has made it so that you've gone from owning 10% of the company to 15% of the company. And during that time, the company has been more and more profitable. So that's solid, right? That we, as an owner, we really like that. To put it in perspective, your share of the company earnings, your 32.5 million shares would have meant you really owned about $48.57 million in profit in 2008. Today, those same 32.5 million shares entitles you to about $98.18 million of what we'll call owner earnings. So this is a really solid benefit of companies buying back stocks, and it's one of the reasons why I like H&R Block as a long-term hold. So the next slide, first we'll talk about dividends. The dividends for this company have gone up pretty dramatically. If you look at it, it looks like in 2013, the dividend sort of leveled off and even looks like it dropped again in 2015. But that's the total amount of dollars that they paid in dividends. And you remember they're paying out those dollars on an ever decreasing amount of stock in terms of total shares outstanding. And so when you look at dividends per share, you see it's gone up pretty nicely, pretty dramatically over the last, really since 1999. It's just been a great payer of dividends. The dividend yield is 4%. We're going to talk about it in a minute. But this is a company which, between buying back shares and paying back dividends, really is doing a very nice job of rewarding us shareholders. So when looking at a company's dividends, again, we look at four factors. We look at what is the yield and what's the growth of that yield over time. What's the dividend safety in the context of earnings? So how likely is the company's earnings going to be able to, how likely is it that the company's earnings will be able to continue to justify paying the same dividend they're paying now? Dividend safety in terms of the context of cash flow, and dividend safety in the context of the company's current debt load. So we'll go through each of these piece by piece. So first, in terms of yield and growth, the stock currently yields 4.02%. Again, the S&P 500 is 1.92%, so really twice what the S&P average company is paying. The average growth over the last 5 years has been 4.8%. That's a little bit misleading. The dividend growth for the last 2 years has been, in the 8% range, but for the first couple of years it was pretty flat. In fact, it was flat. So it's done great the last couple of years. Longer term, it hasn't done as well, but we'd be happy with 4.8% dividend growth. That's about 1.5 times inflation. We could live with that. It's not, something to write home about, but it's not bad either. So dividend safety in the context of earnings, the current payout ratio is 38.2%. The average payout ratio for the last 5 years is 46.1%. Really anything under 70 or 75% is probably a pretty sustainable payout ratio, especially if a company's been able to do it for a long time like an H&R Block has. But the average payout ratio for the S&P 500 is around 40%. You can see that the payout ratio for the last 2 years has been declining, which means that the stock is ever safer in its ability to continue to pay dividends in the long term. Dividend safety in the context of cash flow is just maybe a little bit more accurate way of looking at the payout ratio, a little bit more complete. So the dividend payout ratio in terms of free cash flow is 26.7%, and that number has been getting better and better. It's gone down significantly. And the average payout ratio for the last 5 years was 33.1%. Again, anything under 50%, and we have no concerns at all. The company should be able to continue to pay dividends in the long term. Dividend safety in the context of debt, it's really not an issue. The company has very little debt and it's paying very little interest. If interest rates went to 20%, for example, it would cause a reduction in cash flow due to interest payments of $216 million. Their new interest adjusted cash flow would have gone from $750 million to $553 million. They currently pay $200 million in dividends, which means that they would free cash flow after dividends and debt service of $334 million, which means the dividend payout of cash flow is 59%. So what this is saying in the long run is, if interest rates went to 20%, this company would still only be paying 60% of its cash flow in dividends and interest. So that is really not an issue for this company in terms of its ability to continue to pay dividends. It's very rock solid in that sense. So shareholders' equity, you'd like to see shareholders' equity sort of increasing over time, but we've talked about it. What this company has done is they've bought back so many shares and paid so much in dividends, and when they do that, that reduces the amount of equity. So it looks like they have very little shareholder equity. It's not a problem. It actually makes it very easy for the company to get great returns on equity because they don't have very much. Because I know they're paying a dividend, it's very solid. Because I know they're buying back shares, I know their debt has been relatively stable. I'm not really concerned about this lack of shareholder equity. So one of the things that we really look for outside of a company being a consumer monopoly is its return on assets. You can see the return on assets for the company have gotten better and better every year since 2012. They're now significantly above the top 10% of companies. And remember, this is a company that's in the top 10% of companies in terms of return on assets. And it's doing that at seven times earnings in terms of a purchase price. So that's really one of the big reasons why I'm so hot on the stock. It's got a very stable business. We're not going to quit paying taxes. It's got good returns on investments. It's got good margins, good return on assets, I should say. It's buying back shares, paying back dividends. I mean, these are all things that really make this stock very attractive as a long-term play. So when I'm done doing my analysis on a company, I start to ask myself some questions about whether this company has the characteristics that I look for in investment. And the first question I ask is, does the company have a consumer monopoly? One of the real indicators of a consumer monopoly is a company's ability to have pricing power, which is easily measured as gross margins, or at least easily initially measured as gross margins. This company has better than average gross margins, which is a good sign. The other thing I look for is, does the company have a brand or logo that people would tend to recognize and go to? So H&R Block clearly has that. If I say H&R Block, everyone in the room knows what you're talking about. They know you're going to do your taxes. By the way, they also know a little bit about who you are if you're going there. You're probably not, a 1%er. If you're a 1%er, you're going to a major accounting firm. This is for, H&R Block is for Joe Lunchbox. And for Joe Lunchbox, it's either H&R Block or one of their software systems or TurboTax. Is there really even another supplier of tax advice and tax preparation stuff for Joe Lunchbox? There is, but you won't recognize the name, or you won't have thought of the name until I tell you. The company's name is Jackson Hewitt, but H&R Block by far is the largest and the most successful. So the company does have a consumer monopoly, both as measured by gross margins and as measured by the fact that it does have some brand awareness in the public's mind. The next question is, the company solid financially? They're in a solid, stable business. Taxes are not going to end anytime soon. They make $700 million a year. What can hurt them, right? I mean, in theory, if we came up with a flat tax, that could hurt them. In theory, if we came up with a national sales tax, that could hurt them. You know what's going on in Congress as well as I do. I'm not really that worried about it. They've reduced its cash and marketable securities from $3 billion to $750 million. But most of that's been paid to shareholders in terms of dividends and share repurchases. So despite that, for 2 years running, the company's increased its its gap between current liabilities and current assets. The debt is under control. If interest rates went to 20%, they wouldn't have to cut their dividend. So in terms of solid financially, I think it's very fair to say this company's in solid financial shape. Total debt has decreased from $6 billion in 2007 to less than $1.5 billion today. Long-term debt has increased slightly over the last 5 years. But the years to pay off debt from profits has decreased to close to historically low levels. So I'm not really worried about the debt. Does the company reward its owners? Yeah. In addition to growing earnings year after year, the company pays an above-market dividend. It's paying effectively twice the average market dividend. That dividend is growing at 1.5 times inflation for the last 5 years. The company has repurchased the company has repurchased 116 million shares in the last 10 years with a market value of $2.8 billion. So I have no trouble suggesting to you that the price at where I'm doing this report is 24.76 cents a share, and I would have no qualms at all suggesting you should buy this company at that price. So the next chart we look at is the stocks that we've suggested you should buy. You remember that Altria, the other week we told you that we should get out of it. So you should sell your initial stake, take your profits and reinvest it. But the rest of it we should cash out. So we did well on that stock. We made about $1,800 on a $900 investment. Other than that, T. Rowe Price is up about 7.2% since we bought it. Argan is up 7.7% since we suggested you should buy it. Martin Transport is really flat. It's up less than 1%. Apple is up 4%. And Altria, since we told you to sell it, if you'd reinvested the profits, those profits would be down a little bit, but really a de minimis amount. Nothing to worry about. And now we're telling you to buy H&R Block. You should buy, if you want to invest about $10,000, we're going to buy 403 shares, which is worth $978. So that's my report for this week. Again, go out and buy H&R Block. It should do well for you. Thank you very much for your time.